Junk bond yields are surging, and that's a red flag you shouldn't ignore. With spreads widening and risk premiums jumping, are we seeing the early signs of a deeper economic contraction? Stocks may have bounced, but credit markets tell a different story. We'll break down what this means for investors, default risk, and market volatility. At the end, you'll know why junk bonds may be the canary in the coal mine.
Gary, we're moving over to the junk bonds. We saw junk bond yields surge, sell-off intensified. The question that you listed is, are you watching the default rates? Gary, we're moving into thing number 4, junk bond yields surge as the sell-off intensifies. Tell us what's happening with these bonds.
All right, Rob. Well, let's give people a little background on this. I'm sure people listening to this have heard the term junk bonds and wondered what they are. So a junk bond is a corporate bond. It's not a government treasury. It's a bond that would be issued by a company. And the junk bonds are bonds that are below investment grade level. It basically means high yield bonds where people are concerned about the risk of being repaid. The yields on junk bonds have been surging following the introduction of the Trump tariff discussions. And it's the biggest sell-off in the junk bond market since the 2020 COVID-related sell-off. Now, that wasn't that long ago, but, still a pretty big number. So for people who are wondering, what does all of this mean? The easy rule of thumb to contextualize yield is to understand that it's a measure of risk. Typically, things that are lower risk, you get paid less for it, right? It'd be like, if a billionaire owed you $100, you wouldn't really worry about the repayment risk because they can. It's not a big deal. If somebody who has maxed out all their credit cards owes you $100,000, you may have a problem and somebody's going to want a higher interest rate for that. So because of that, when there's economic stress, we typically see movement in junk bond yields before other yields because investors will be the quickest to flee higher risk assets in case of uncertainty. When they do that, those yields go up, and that's what we're seeing. So according to the Bank of America US High Yield Index, junk bond yields rose 111 basis points. That's 1.11% just in the first week of April. And the spread between junk bond yields and the US Treasury 10-year yield was up by 116 basis points. That's 1.16% over a 5-day period. That is a huge move in a short time.
Gary, with that, so you're saying that pricing, the market is pricing in more risk on low equity corporate bonds. What else are you going to be watching from here on out?
So I think you called it at the beginning of this segment, Rob, when you talked about default rates. And this is something that, we watch for both consumers and for corporations. And so the question is, and we had the earlier segment with Dean Smith of Folio Beyond, where he said, hey, listen, it takes a while for these things to move this through the system. And it's true. Nobody who is 30 days late gets collected on. You have to go 90 days before anybody tries to collect. And so, the thing to watch is, will this increase in junk bond yields and the increase in the junk bond yield spreads over treasury bonds lead to more defaults down the road? Because here's the thing, a higher yield on bonds that eventually get paid doesn't really matter. It simply means that the original buyers of those bonds will either lose a little bit of money or earn a lower return, and the subsequent buyers of those bonds will earn a higher return. And, that's basically a zero-sum game amongst bond investors. And that's not really that big a deal. Where it becomes a big deal is if those bonds don't get repaid, right? So higher risk, higher yield, pay your bills, it'll all be fine. If we start to see higher default rates, then we have an economic